Welcome back to Muscular Brain, Fat Wallet. If you've been following along, we're in the middle of a two-part series on the mistakes to avoid when investing in rental properties. In part 1, we covered essential points like doing your research, setting realistic expectations for rental income, and managing financing smartly. In this video, we're diving even deeper into the challenges you'll face as a landlord, everything from tenant management to legal issues to creating a long-term strategy for success. These are equally important factors that can make or break your investment, so stick around and make sure you don't miss out on these critical tips. If you haven't seen part 1 yet, I highly recommend you check it out first. As always, don't forget to hit the like button, subscribe, and turn on notifications so you won't miss any of our valuable wealth-building content. Now, let's get into it. Section 5. Not having a long-term strategy. Many investors get caught up in the excitement of buying rental properties but fail to plan for the long term. Real estate is a marathon, not a sprint, and having a well-thought-out strategy is key to growing your wealth. Short-term thinking. Focusing solely on short-term cash flow is a common mistake. Yes, you want your property to generate income, but rental real estate is also about long-term appreciation and tax advantages. If you're only concerned with how much you can make month to month, you might overlook opportunities to build more wealth over time. Remember, real estate markets can fluctuate, and there will be periods where appreciation slows down. Having a long-term perspective ensures you're prepared to weather these ups and downs while capitalizing on long-term gains. Ignoring tax benefits. Many landlords miss out on valuable tax benefits that can significantly impact their overall returns. For example, rental property owners can deduct expenses such as mortgage interest, property taxes, maintenance costs, and even depreciation. Depreciation allows you to reduce your taxable income, even though it's a non-cash expense. Additionally, if you decide to sell one of your rental properties, you can defer capital gains taxes by using a 1031 exchange. This allows you to reinvest the proceeds into another property and continue growing your portfolio without immediately paying taxes. Ignoring these strategies means you're leaving money on the table. Not planning an exit strategy. Every investment should have an exit plan, and rental properties are no exception. Some investors hold properties for the long term, while others prefer to sell when the market is strong. Either way, you need to have a clear strategy for when and how you'll eventually exit the investment. One common mistake is waiting too long to sell, hoping for the market to improve even further. This can lead to missed opportunities if the market takes a downturn. Others may sell too quickly without fully leveraging their property's appreciation potential. It's essential to regularly assess your portfolio and adjust your strategy based on market conditions and your personal financial goals. Section 6. Poor tenant screening and management. Managing tenants is one of the most hands-on aspects of owning rental properties, and it's an area where many new landlords make costly mistakes. Good tenant relationships are the backbone of a successful rental business, and neglecting them can lead to headaches, legal issues, and financial loss. Not screening tenants thoroughly. One of the biggest mistakes you can make is skipping proper tenant screening. Some landlords rush to fill a vacancy without thoroughly checking the tenant's background, employment, and rental history. This often leads to bad tenants who may damage your property, fail to pay rent on time, or violate the lease. To avoid this, you need a robust tenant screening process in place. This includes running a credit check, verifying income, contacting previous landlords, and checking for any criminal history. Don't hesitate to take your time with this step. Choosing the right tenant is critical for the long-term health of your property. Neglecting to build relationships with tenants. Once you've found a good tenant, the work doesn't stop there. Maintaining a positive relationship with your tenants is key to keeping them happy and ensuring they stay long-term. Happy tenants are more likely to renew their lease, which saves you from the cost and hassle of finding new tenants. Stay on top of maintenance requests, be fair in your dealings, and maintain open communication. Respond to concerns promptly, and always follow the terms of the lease. Treating tenants with respect can help reduce turnover, which in turn reduces vacancy and renovation costs. Delaying evictions when necessary. On the flip side, sometimes you'll face difficult situations where tenants stop paying rent or violate the lease. One mistake many new landlords make is delaying the eviction process, often out of sympathy or fear of the legal steps involved. However, delaying can lead to months of lost rent and even more damage to your property. It's important to familiarize yourself with the eviction process and take swift action when necessary. While evictions can be uncomfortable, acting quickly can help minimize financial losses. Remember, owning rental properties is a business, and sometimes tough decisions are necessary to protect your investment. Section 7. Failing to understand local laws and regulations. Investing in rental properties isn't just about finding tenants and collecting rent. You also need to comply with local, state, and federal laws. Ignoring these legal requirements can lead to costly fines and legal battles. Not complying with landlord-tenant laws. Every state has specific laws that govern the relationship between landlords and tenants, and these laws vary widely. They cover everything from security deposits to eviction procedures to tenant rights. As a landlord, it's your responsibility to know and follow these laws. For example, if you're in a state with strict tenant protections, you might be limited in how much you can raise the rent or how quickly you can evict a tenant. Failing to comply with these laws can result in fines, legal action, or even the loss of your property. It's a good idea to consult with a real estate attorney or property manager to ensure you're compliant with all relevant laws in your area. Violating fair housing laws. Another legal mistake to avoid is violating fair housing laws. These laws prohibit discrimination based on race, color, religion, sex, national origin, disability, or familial status. Violating these laws can result in hefty fines and damage your reputation as a landlord. To avoid violating fair housing laws, make sure your tenant screening process is consistent and non-discriminatory. Never base your decisions on any of the protected characteristics. When advertising your property, avoid language that could be seen as discriminatory. Ignoring building codes and zoning laws. Building codes and zoning laws regulate the types of properties that can be rented, the renovations you can make, and the number of tenants allowed. Failing to follow these rules can lead to fines or even forced renovations. Before purchasing a rental property, make sure it complies with local building codes, and verify that any planned renovations are permitted. It's always better to spend the money upfront on proper permits and inspections than to face legal troubles down the road. Section 8. Failing to keep up with maintenance and property care. Maintaining your rental property is crucial not only for keeping your tenants happy but also for preserving the property's value and avoiding costly repairs down the line. Neglecting maintenance is a common mistake that can hurt your investment in the long run. Underestimating routine maintenance costs. Many new investors don't fully account for the ongoing costs of maintaining a property. It's not just about major repairs. Routine upkeep like lawn care, plumbing, HVAC maintenance, and appliance servicing are all part of the cost of owning a rental property. A good rule of thumb is to set aside 1–2% of the property's value each year for maintenance. This ensures you have a financial buffer for any unexpected repairs and helps prevent larger issues from developing. Neglecting preventative maintenance. Preventative maintenance is one of the best ways to protect your investment. Small issues, like a leaky faucet or a loose tile, may not seem like a big deal at first, but they can quickly turn into major problems if left unaddressed. Regularly inspect your property and tackle repairs as soon as they arise. Staying on top of maintenance not only saves you money in the long run but also keeps your tenants happy and willing to stay longer. Skipping property inspections. Failing to inspect your property can lead to problems going unnoticed for too long. Some landlords only check their property when tenants move out, but by then, significant damage may have already occurred. Regular inspections allow you to catch issues early, protect your investment, and ensure the property is being properly cared for. Conclusion. That wraps up part 2 of mistakes to avoid when investing in rental properties. We've covered the challenges of tenant management, legal compliance, and property maintenance, key areas where even experienced investors can slip up. Avoiding these mistakes will help you manage your rental properties more effectively and build a successful, long-term real estate portfolio. If you found this video helpful, don't forget to give it a thumbs up, subscribe to Muscular Brain, Fat Wallet, and turn on notifications so you never miss out on our wealth building content. Thanks for watching, and we'll see you in the next one.